Welcome everyone to another episode of My Private Network. Today we have a special guest, Sean Rochester, an esteemed figure in the world of private lending. And I think Sean's laughing in the background when he hears the word esteemed. But before we delve into our discussion on short-term senior secured private debt, let's take a moment to reflect on a previous episode. Now, back in episode 1, we interviewed 5 prominent members of the private debt community asking the question, why allocate funds to private debt? One of our guests was Sean, a seasoned professional with extensive experience managing investments in private debt for a Canadian pension fund. Now, we explored why pension funds have been increasingly investing in private debt and why individual investors have been somewhat hesitant to include private debt in their portfolio. Feel free to go back and look at episode 1 and see what Sean was saying back then. But today, Sean's back. So welcome, Sean, to My Private Network podcast.
Thanks very much, Bob.
Yeah. So before we dive into the specifics, let's allow our listeners a little bit of time to get to know you better. Now, I have a question for you here. Is it true? Because I heard the story from somebody and I just want to know if it's true or not. Is it true that you and your partner began your journey working out of a bike store in Oakville? Maybe you can share part of this journey from those early days to becoming one of Canada's premier private lenders.
It's an interesting introduction. The background that comes to the bike store is that I was running fixed income at Ontario Teachers Pension Plan, and my co-founder, Bruce Shirk, was running a private debt investment management business that teachers allocated a significant amount of money to. And in order to support that allocation, we had to buy equity in the firm because that's what our board required back then. It was one of several investments that we tried to develop, and it was very successful, but probably about 5 in the short-term secured debt markets. And Bruce and I got to know each other then when we were both available and really wanted to build this business. We set ourselves up as Cortland Credit Group. We thought we had the ideal group. From my institutional background, I knew this had an area that had very strong risk-adjusted returns, but it was also a floating rate-based asset, which means that it offers great diversification. It's conservative because it's got real assets supporting it, but at the same time, it's floating. So it's a great component of a fixed income portfolio where most of the assets are the fixed pay that will have the challenge of, in a rising rate environment, they'll have negative performance. So this is an asset that has strong performance in a positive rate environment. So we had this great idea of adding great value for institutional investors. And at the same time, we had the background that my partner Bruce had on lending money in this space and knew there's a huge sector. Over 98% of the businesses in Canada are under 100 employees, which means they can have trouble raising capital from traditional banks. So we knew we had a great space to go into and put our money. The fact that it took 3 years before we actually got our portfolio up to about 50 million, where we could start to take a paycheck and afford to move to a new office, was a little bit surprising, because for the first 3 years we were there above the bike store, the Gears bike store at Trafalgar Road in the QEW, working in basically very tight quarters with Bruce and I, and we slowly added 1 or 2 people on the operations and bookkeeping side. But did take a little while to get the business to that scalable level where we could move to a new office.
Yeah. So do you ride a bike to work right now?
I didn't. I'm downtown now, so it's a bit rough riding a bike. I probably should, the way all the bike lanes are changing in Toronto, but that's a separate discussion.
So you've kind of talked a little bit about short-term senior secured private debt, Sean. Maybe take a few minutes just to add a bit more. Explain to everybody, what is senior secured private debt?
Well, I think short-term is an important term as well, because in the institutional world, when you're looking at carving up your portfolio into long-term and general fixed income strategies, they kind of skip over the short term, which is generally perceived to be 2 years term to maturity and under. And where Cortland operates is primarily 1 year and under. We have about, we have a few loans out to 1.5 years, and I think 1 or 2 longer, but 80% of the portfolio is targeted to be under 1 year. So very much a short-term book, but the senior secured part is something to consider in the corporate world. When you do a mortgage on your home, if you have one, you have to register the home as collateral for that loan, and no one else has a senior claim on it above the bank. If there's anything happen with your debt servicing capability and they call that loan, then you have to hand over your house as the underlying collateral. That is the same strategy effectively that Cortland uses. We generally look to the liquid working capital that make up a significant part of our borrowing base. So it'll be the accounts receivable, sometimes inventory, that would make up the working capital of the borrower. And that accounts receivables, in a way, a hard asset because it's a clear contractual claim that the borrower has on the people they've sold a good or service to, that end client of theirs has to pay them back within 45 to 90 days. We have a claim on that if the borrower isn't able to service their debt with us. And it's a great exit strategy because all you do is stop financing, collect on that accounts receivable, and you're out of your loan. It's much different than being forced to foreclose on a house and then sell the assets in the market. And that is a strategy we used for when we do short-term loans. So probably 65 to 75%, call it 2/3 to 3/4 of our book is those revolving working capital assets as the collateral. For the remainder, it will be fixed term. Could be property, plant, and equipment. Sometimes it actually does include land, but anything, whether it's property or equipment, we will always get appraisals on that at the liquidation value because we want the borrower to repay us. But if something happens and anything goes wrong and we have to get to a default scenario, then we're going to have a claim on those assets and we have to sell them at what we can liquidate them at. So that model is pervasive across the Cortland strategy. That's short-term senior secured lending.
Yeah, so everybody understands the short term. And I think really what you're saying that people could grasp the concept of if you're going to do let's say you're going to invest in a mortgage, in somebody's mortgage, you primarily want to be in a first mortgage, not the second or the third mortgage.
Right.
The risk gets higher as you go down the list. So a first mortgage would be a senior
Yep,
loan in
that's right.
in that example, right?
But it's short term because a mortgage might be a 5-year mortgage. That would not fit with our model. We're looking for 1 year and under generally for most of the portfolio.
Yeah, and if you're doing receivables are probably 30 to 45 days. Is that not the case?
Yeah, 45 to 90 would be a good general statement.
Is that a big part of your portfolio?
It's going to be 2/3 to 3/4 of it. Yeah.
So really, when you lend against receivables, you're really taking on the risk of the company to whom the receivables made out, right? Let's say if somebody has an opportunity to sell to Costco, but they don't have funds to produce that deal, then you would take over that receivable. So it would really depend on Costco's ability to pay on that.
And that's exactly it. And just add one other item, and that is that basically all of our borrowers have more than one entity that they're selling their good or service to. And so the portfolio of, say, 40 different borrowers have many thousands of underlying accounts receivable counterparties. So it's actually highly diversified well beyond those 40 borrowers.
Right. And one of the things that you look at there is what's the credit quality of the company to whom the invoice is made out to, right?
Right.
So you can kind of pick and choose based on that. You know, in a previous life, and I don't think I ever actually told you this, that I worked for a firm that did credit insurance. And I think you use credit insurance a little bit.
We do.
To protect a layer of the portfolio. Is that right?
Yep. There are groups that we fund on the financial side where they in turn do what's called factoring, where they buy the accounts receivable from the underlying borrowers, and that's how the borrowers pay for their working capital. But on those where it's factoring, they always have 100% insurance on that underlying accounts receivable. They're just a little too small for us to fund their underlying borrowers, but they'll have 8 or 10 different borrowers that they're factoring their accounts receivable for, and those are all insured. We do have that within the portfolio as well.
Yeah, so one of the examples, so you're using accounts receivable as the collateral on this. Maybe just spend a second and talk about how you look at an opportunity to make a loan to a corporation and what's the process that you go through. Maybe an example of a type of loan that you've made and what's the process that you go through to get that thing done.
Yeah, a big part of our portfolio is a pretty good fit for your question, and that is the IT area where we're funding companies that are in the IT space. Sometimes it's providing cloud storage facilities to big municipalities and big corporations. Sometimes it's cybersecurity services. Sometimes it's a little bit more about selling servers to the big universities where they're constantly buying more computers, but they have to have those servers configured to fit the university's model. So they buy the server from an IT firm that in turn buys it from HP or IBM, but that IT firm does the configuring of the system so it fits with the end user's model. That's called a value added reseller. And in any case, those IT firms, there's over 30 of them that we've funded in the last 5 years. And those firms are all looking to provide us with a claim on their accounts receivable from their institutional clients primarily. Could be big corporations, but a lot of them are the municipalities, the universities, the hospitals, all the people that have big data requirements and are regularly buying those servers. So those make up a big part of the portfolio. When we look at them, we look for a 3 to 5 year history of clients that they've been selling that good or service to, in this case, the IT equipment to. We like the repeat buyers because then we don't have to do a lot of work on doing credit checks on their underlying buyers. But we always do a weekly review of that borrowing base that the borrower comes to us with. And we constantly check that pool of accounts receivable to make sure it matches with what we have agreed to in the overall funding commitment. And we approve those borrowers. If there's a borrower that has a history of not paying its accounts payable to the borrower, then we'll say that's not approved in the borrowing base. We check the borrowing base as it comes to us against their online bank statements to say, if the borrower says to us, yeah, I just collected on 2 million of accounts receivable, then we'll look at the bank statement and say, well, that didn't show up. When is that expected to come in? And we would allow it to be included in the borrowing base when it comes in. And I think that's a very unique feature that Cortland has developed. And it was to Bruce's credit, it was a model he developed in his prior role, but what I really liked about his platform. And we do that at Cortland, and it's a very strong part of our overall credit management that we can oversee and kind of reinvent our lending arrangement with the borrowers on a weekly basis.
Yeah, Sean, one thing that I've always said, having a fairly extensive fixed income background myself is, if you're going to put money out, you're going to get, 4, 5, 6, and, in this case, numbers up into, the high single, low double digits, that for that kind of return, you don't really want to risk your capital.
Right.
So one of the things that you said in episode 1 was that, for being a bond manager, it's pretty easy. You just look at the credit rating agencies. You can read the report, see it's a double A, single A, or whatever. You can make judgments based on that. You don't get that, do you, when you're doing private?
No, you're right. And a good institutional investor can't really abdicate all responsibility to the rating agencies, but the role the rating agency plays is a third party assessment of the credit quality of that borrower. And we don't have that. We do use an independent review committee that reviews our processes, and they'll go and pick our 3 to 5 largest loans and go through the credit analysis we did of the ongoing borrowing base review that we have to see if we've stuck to our process. Absolutely. But the actual due diligence on that borrower, the review of the credit quality of their underlying accounts receivable and the liquidation value of their assets, we use third parties to do that for anything that's a fixed asset, like a piece of property or equipment. But the actual accounts receivable, we do the due diligence on their underlying portfolio, and it's ongoing, and it's required that we do that carefully on our side.
And that's a big part of your focus, isn't it? It's almost more important that you look at the asset against which you've written the loan as opposed to even the cash flow. Or I know it's a combination of the two, but do you slant one way or the other in that regard?
The way I would characterize it is we always look to the borrower to be responsible for repaying us, but if anything goes wrong, we have an exit, which is the underlying collateral. If it's accounts receivable, we just stop funding and collect on it. If it's equipment or property, we foreclose and then we'll liquidate those assets in a normal market process, which we hope is quick, but it's not as quite as clean as accounts receivable, and that's why we really like, and the majority of our portfolio is based on that accounts receivable type of collateral, the liquid working capital collateral as our borrowing base.
So, changing directions a little bit, over the last year or so, we've seen pretty significant negative movements in the bond market, mostly due to rising interest rates. And I think a lot of investors got caught a little bit that they didn't realize that when rates were zero and they were paying a manager as much as the return on the bonds that they were purchasing, that they were going to be in trouble when rates rose. And I don't think anybody thought they might rise as much as they did. But during that negative period where things like XBB, the benchmark ETF, I think was down 11% total return over that year. How have your portfolios done in comparison?
It is interesting that the worst year in the history of the capital markets for that traditional 60-40 equity fixed income mix happened last year. And it was rough on a lot of investors, but pardon me if I look at it as interesting, but the interesting part for us was that was the best year in Cortland's history, and this year is going to be better. And we didn't do anything different. We didn't do a punt on what's going on in the market. We just continued our lending model, but that is as a floating rate asset where we lend to our borrowers at a spread over bank prime. And bank prime was 245 2 years ago. I know that overnight rates were basically zero, but banks would lend at a minimum of 245, their prime lending rate. Now it's 720, so it's up about 465 or so. And our yields went from 5.5 to 9%. So we're up almost exactly the same amount, which really reflects the fact that we've got a portfolio that hasn't changed its model, but it's a floating rate portfolio and very good spread over traditional fixed income assets while being pretty well collateralized. So it's actually more collateral support than you get with traditional bonds. They're what they call limited recourse or unsecured promise to pay by the borrowers in traditional corporate bonds. In our environment, we have real short-term and senior secured status on the collateral, and that has made for a much more reliable and conservative portfolio with better consistency and returns. And because it's private debt, it gets a big bump in what I call the alpha, the excess return over the traditional index. And that is the result of that ability to provide capital where traditional banks don't want to go. But for investors, it means significantly better value for your investment dollar.
Yeah. So what kind of spreads are you lending over the prime rate?
So we lend at prime plus, call it 4 to 8 or 9%. And off of that, we take the underwriting cost or expense of rolling the assets over every week. That's a 1.7%. And then there's a management fee that I think is small at 45 basis points, but all in about 2.15% of economics. So we're lending at call it 10 to 11 or 12%. And our net yield for our investors is in the 8 to 10% in the return they're seeing in this environment.
Mm-hmm. So I guess the question that people who are listening to us might ask is, why would people borrow from you at those rates when they could potentially borrow from a bank at a much lower rate? So really, why are borrowers turning towards private lenders instead of working with the traditional banks?
Well, just imagine that you had a project that you wanted to, establish a new building because you've got a whole bunch of new sales coming in, you got to set up the oversight of that or the production facility to do it. Or if it's a private equity manager buying another company and that they want to make sure they can fund that acquisition and look to the collateral of that borrower as a part of the funding cost. So they would come to us and say, hey, can you look at the collateral of this underlying borrower? Would you provide us some capital with that as collateral? And if they took that to a bank, the bank would say, well, let us take 6 months to a year and go through that. And it might be a no. We can give them feedback within 2 to 3 weeks. We think this fits well. And then we'll do the ongoing deep dive due diligence on every component of it. But they have a good indicator, and we have a long track record of being reliable in that indicator. But we do the final commitment 6 to 8 weeks later. But that's a very short turnaround for them for working with us as compared to a bank's financing model. And I can tell you there's lots of examples. So we do lending occasionally in the US. A US bank will only lend against US assets. But you have a borrower that has got, they're selling IT equipment in the US, but also they're selling IT equipment to the Canadian government. And those US banks won't take that as collateral. Whereas we can provide that funding, we can hedge the US dollar risk, but we can provide the funding to them. We can take all the components of that as collateral.
So it's really, you're talking about flexibility, and businesses, I'm sure, find it pretty difficult with the bureaucratic nature of working with the banks, that by working with somebody, maybe it's worth a bit more money to get your hands on the money when you need it, as opposed to waiting 6 months to a year.
Yeah, plus these smaller firms, the banks get a little bit nervous that they don't understand all the collateral. They got to do a ton of research on it, and then they've got to do the ongoing tracking. For a small firm, it may not justify that weekly, well, it won't justify a weekly borrowing base review. They may get comfortable with monthly or quarterly borrowing base, but that's generally for larger firms. The smaller firms that we deal with, you've got to do an ongoing and deeper dive into the ongoing development of their revenue. What is their accounts receivable that is turning over in that? And I can tell you that we have on our revolving loans, you can have 20 to 30% of the portfolio turning over every month.
Hmm.
It's a lot of monitoring work.
Yeah. Sounds like you're earning your fees on this, as opposed to a bond manager where all they have to do is go out and figure out the duration of the bond and the credit quality and make a call, right?
I was on the other side of that conversation quite a bit. It's
Yeah.
you know that it's sometimes a directional bet on interest rates,
Mm-hmm.
and that can take a lot of work, but the actual execution could be just a bond, and it could be the 5 year versus the 10 year or something like that. But yeah, there's a different set of decision parameters.
Yeah, a little easier. Now, for the individual investor or maybe a family office who's looking to diversify their portfolio, how would you recommend using short-term senior secured private debt in a portfolio? Now, is it a viable alternative to both growth investments such as stocks and or income investments, things like bonds and GICs?
Yeah, I really recommend that people look at this as a conservative fixed income portfolio because it's going to generate a very consistent performance and return. It'll be the thing in the corner of your portfolio generating at that return through thick and thin, but it's never going to give you 15 or 20% return in 1 month over others because you make a good call on individual stocks that have a lot of potential growth. This is more of a consistent conservative allocation and can be a long-term allocation within a strategic portfolio investment plan.
Yeah, but even for an investor who is maybe getting weary of the roller coaster ride of equities over the last few years, one of the numbers I follow really closely is that if you bought the S&P 500 back in December of 1999, that you would have received a total return of about 6.5% per year over that period. Your thinking is with the spreads over things like bonds and GICs or over prime, especially, that you could probably come pretty close to getting equity performance without that risk or volatility.
Yeah, that is my view as well. A lot of people will look for equity returns to be higher because they're taking a lot more risk with it. But if you look at that historical data, you can get a sense that it's actually hard to actually deliver that. Whereas our strategy has been, quite reliable.
Now, one thing that I've heard from people in your firm is that you're working on a new concept that we're hoping to list on PD&E as well. Can you maybe give our listeners a bit of a sneak peek as to what you have in mind there?
Yep. Thanks, Bob. Keep in mind that my background is very heavy on the derivative side over the course of my career. And so we did identify that there's an opportunity right now to participate in bank stocks with the upside only and without the downside risk by buying options on the bank index. Now we can pay for that option with the alpha, the excess return that Cortland generates. And so you get access to only the upside on equities. And even if equities do nothing, you still make 5% return on the Cortland strategy over the 3-year term of this investment. We can't do it forever, but we can do a 3-year option on the underlying equities that get you that return. And because we are doing a different model, we don't participate in the management fees in this model. We only participate in a portion. I think we set it at 10% of the upside in the equities, but we don't have a management fee. So if nothing happens, investors are much better off than they would be just investing in Cortland or in this strategy on its own. And if the market goes up, they're still going to get all the unlimited upside that you can get with equities if they really do deliver strong returns. And we picked the bank side because historically banks have done very well for investors. The challenge, of course, is that there's a lot of uncertainty in the market right now as to whether or not banks will be able to deal with more requirements for regulatory capital, or will they be able to come out of this as they have in the past? To help investors with that uncertainty, they can get access to this where the cost of that option is covered by the alpha from Cortland's strategy.
So I want to just extend a big thank you, Sean, for you spending your time with us today and sharing your valuable insights.
Thanks very much, Bob. Very thoughtful questions.
This podcast episode will be available on privatednequity.ca as educational content for short-term senior secured private debt. Please don't forget to follow us on your favorite podcast platform, subscribe to our YouTube channel. Now, before making any investment decisions, it's essential to consult a professional financial advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. Remember, knowledge empowers you to make informed investment choices and reach your financial goals. So until next time, keep your head up and keep your stick on the ice.